Welcome, titans of finance, future strategists, and data alchemists. Are you ready to transform raw numbers into strategic foresight to build financial models that don't just predict but dominate the narrative? Today we embark on an epic journey, the Financial Modeling Masterclass. Now, before we deep dive, I have something special for you. This comprehensive financial model that we'll be building sheet by sheet will be a powerful tool for your learning. And I'm making it available to only those who truly crave it and are committed to mastering the financial modeling. If you want access to this complete polished model, simply drop your email ID in the comments below, along with a piece of feedback on what you truly liked about this specific video or the Bankers Bootcamp YouTube channel in general. Your insights help us grow, and in return, you get the keys to this powerful tool. This isn't just about spreadsheets. It's about empowerment, precision, and unlocking the true potential of your financial analysis. Over the next 3 videos, we are going to build a full-fledged institutional-grade financial model sheet by sheet from the ground up, and trust me, by the end of this series, you will be modeling with a confidence you never thought possible. In this first power-packed session, we are laying the unshakable foundation, understanding market dynamics, setting up core schedules, and crafting assumptions that breathe life into forecasts. Let's dive in. So here we have on the screen the cover page of the Ashok Leyland Limited. Now, why Ashok Leyland? There are a lot of reasons for it. First of all, it's India's trusted commercial vehicle brand, the CV cycle turnaround plus EV ambitions. So basically, we are seeing a dual growth levers over there. It's undervalued relative to peers and a play on Make in India and infrastructure story. So it's just isn't the cyclical trade. It's a rare intersection of legacy strength, electric disruption, and valuation comfort. Every robust financial model begins with data, the heartbeat of the market. You can't predict the future without understanding the past and the present. Here, on our market data sheet, we are capturing crucial external variables that will influence our projection. For our Ashok Leyland model, ideally you should deep dive into the annual reports like a detective, searching for all the headers. However, remember my advice? First build a model using a data source vendor, and then while revisiting the model, deep dive into the granular details using the annual reports. Now let's move on directly to get the raw data from Screener. So go onto the Google, type screener.in, and there you get it. Open the site and type the name of the company over here, Ashok Leyland Limited. So you will see a page like this. Now scroll below and there you have it. So basically on this page, I have expanded all the details of the income statement, the cash flow statement, and the balance sheet. Now simply you need to copy this data from here to the Excel sheet where you want to build your model. Let's copy. Go to the market data and paste the data over there. Similarly, in the balance sheet data, copy the data and paste it in the Excel. Same for the cash flow statement. So I've tried to segregate it already between the cash flow from operations, cash flow from investment, and cash flow from financing activities. Same, you need to copy the cash from investing activities into the Excel, and the cash flow from financing activities. Don't copy the net cash flow because anyways you're going to calculate this on your other sheet. So this becomes your raw data that will be really handy for our model assumptions. Why is this critical? Because financial modeling isn't a vacuum. We need context. Whether you are valuing a tech startup or a manufacturing giant, you need to understand the economic winds blowing. This sheet serves as a primary external data repository. As you can see, we have incorporated key historical values from income statement, balance sheet, and cash flow statement. This isn't just about copying numbers. It's about curating insights that will inform our every subsequent decision in the model. Notice how we have organized this. Clear headings, consistent time series. This discipline is paramount. Think of this as your intelligence gathering hub. The more comprehensive and accurate your raw data, the stronger your analysis will be. This data will be dynamically linked throughout our model, ensuring our projections are always grounded in market realities. Now, let's talk about the backbone of your operational projections, these supporting schedules. While the core financial statements paint the picture, it's these detailed schedules that provide the brushstroke. Here we are looking at our asset schedule, a critical component for any capital-intensive business like Ashok Leyland, because this is what would come handy when you will compute that depreciation. As you can see, all the number of years are there on the y-axis in column A, and all the attributes that we need are in the x-axis in row 3. The opening gross block, any capex addition for that year, any land. Why I have taken land separately? Because there is ideally no depreciation that happens on the land. The depreciation percentage, actual depreciation, and the closing gross block. And in the end, net block. So how each one is computed? So opening gross block for year 2014 would be the closing gross block for 2013. The capex addition would be whatever the PP&E that were bought during 2014. We have captured land, and the reason I've told you earlier. So capture the amount of land that was bought in 2014. Then what is the depreciation percentage that you have been talking about? So historically, you can simply calculate the depreciation percentage as the depreciation by opening gross block. That will give you the depreciation percentage. Now simply you calculate the depreciation and the net block. So how net block is going to be computed? The closing gross block minus the depreciation. I have considered 0 as the opening gross block for 2014 because this is the year where we are starting our data or the model from. That particular year, the capex addition was 10,981 crores. The land that was bought was of 1,265 crores. The depreciation percentage, as you can see, is the actual percentage of the depreciation captured in 2014. Since it is 5%, I have just simply put down the formula for the depreciation calculation. And finally, the closing gross block. So closing gross block is nothing but opening gross block plus capex addition minus depreciation. This gives us net block value. And there you have it. For the years where you won't have the numbers, the depreciation percentage are simply the average of the historical value. Why an asset schedule? Because capital expenditures, depreciation, and asset base directly impact our income statement and balance sheet. This schedule meticulously tracks our historical fixed assets, additions, disposals, and calculates the annual depreciation. It's the engine that drives our PP&E figures and feeds directly into our income statement's depreciation expense. Now, for simplicity in this model, to keep our focus razor sharp on the core concepts, I have directly assumed rates for other crucial supporting schedules like debt schedule and working capital schedule within our assumptions. However, in a real world scenario or for a more granular model, you would construct separate detailed sheets of each of these. Imagine a dedicated debt schedule tracking every loan, its interest and payments and principal repayments, or a working capital schedule forecasting inventory days, receivable days and payable days to project future cash needs. The principles are identical to our asset schedule. You build them out item by item, linking them directly to your financial statements. The beauty of modular design is that you can build out these detailed schedules whenever the complexity of your analysis demands it, ensuring scalability and precision. Alright, if market data is the heart and schedules are the backbone, then assumptions are the brain of your financial model. This assumption sheet is where we articulate our beliefs about the future. Every single forecast, every projection in our model flows directly from the parameters we set here. This is where arts meet science, combining historical trends with forward-looking insights. Let's talk revenue. How do you forecast something as dynamic as sales? There are two primary philosophies, top-down and bottom-up. A top-down approach starts with broad market size and then estimates your company's market share. For example, if a commercial vehicle market is projected to grow by X% and Ashok Leyland maintains Y% market share, then their revenue will be Z. A bottom-up approach is more granular. It starts with individual product lines, unit sales, pricing, and then aggregates them to the total revenue. Think specific truck models, volumes, and average selling prices. For a theoretical model like ours, especially when demonstrating core concepts, taking an average of historical growth rates or applying a recent growth percentage based on industry trends works perfectly. As you can see, we have made explicit assumptions for our revenue growth here. Now let's jump onto the assumptions. So as you see, I have already prepared all the drivers and what are the percentage of for the simplicity sake. So for example, revenue growth rate. Now you can get the actual revenue numbers till 2024. Simply the revenue growth rate is the current year revenue by last year revenue minus 1. That is, the very first revenue growth rate is 32.46%. Now you take an average of all of them, and the very first number that you see is basically out of the top-down approach or the bottom-up approach that has been discussed during the video. However, for the simplicity sake, we would take it as an average. But also, if you see, I have used a scenario selector over here. Now, scenario selector, you can easily put a drop down and go through its various different scenarios. So the three different scenarios that I've taken is optimistic, moderate, and pessimistic. So the optimistic scenario says the very first revenue growth rate, which is 15.53% that you are seeing over here, is taken as the average of the last 10 years growth rate minus 2%. Why I've subtracted minus 2%? Because ideally, this would be the range for an automotive industry to grow when it has been growing at a really high pace for the last couple of years. And as you can see, the revenue growth rate for the remaining years, I have taken accordingly by reducing the revenue growth rate a bit, because eventually that's how we do the projections of the revenue growth rates. Now, the very first revenue growth number would be the previous year revenue into 1 plus the revenue growth rate that we have got over here. So 52,902. Then the next year would be the revenue of 2025 into 1 plus the revenue growth rate of 2026. That will be 59,886 crores, and so on and so forth. So you can compute the revenue for all the projected years. Now you can clearly see if I change the scenario selector, move it to moderate, it is going to move as per my assumption, which says that for moderate, the first year projected growth rate would be 7.53%. The revenue is going to decrease. So the actual revenue also decreases accordingly. And then I have the pessimistic scenario selection, which calculates the revenue accordingly. Setting the stage for our income statement. Remember, the key is transparency. Every assumption must be clearly stated, understandable, and defensible. No black boxes here. The very first is a raw material cost, which is nothing but a percentage of revenue. So basically, for the raw material cost, we will have the historical numbers with us, which includes WIP inventory. We simply can take it from the market data, so equals to the market data for 2014. Now we extend it to the last historical value that we already know till 2024 and calculate it as a percentage of revenue. So for example, this number would be divided by the current year revenue as a percentage, which is 65%. Now you simply can drag it to the right. So for every year, you will get some COGS. Now the next year projected COGS for simplicity would be the average of the previous year's actual raw material cost, which is 65%, and move it forward as a moving average. Now simply how I can compute the actual raw material cost, that would be this percentage multiplied by the revenue for that particular year. This one also I can drag it to the right. Similarly, I can compute manufacturing cost, which is percentage of revenue, in the same way that I've computed the raw material cost, employee cost, also other cost, and total cost, which is again percentage of revenue. So, and this total cost is nothing but a summation of all of these direct costs that you see over here. If you check, you can compute it with a percentage of revenue as well, and you'll get the same number. Then you take net of other income and take a percentage of revenue, because this is one of the recurring income that I see in case of Ashok Leyland. Now, if it is a non-recurring item, then you can surely skip it. This depreciation that I was talking about, simply you can take it from the asset schedule. Now the interest expense, which is again percentage of revenue, tax expense, which is nothing but taken from the market data for historical values and plugged it over here. The direct tax is also taken historically, and the future numbers are simply taken an average of the historical values. Now let's venture into the fascinating world of valuation parameters. Specifically, beta. Often shrouded in mystery, beta is simply a measure of the stock's volatility in relation to the overall market. It's the critical input for calculating the cost of equity, a key component of our discounted cash flow valuation. Here on our beta sheet, you can see how we have calculated Ashok Leyland's levered beta. We typically regress the company's historical stock returns against a market index like the Nifty 50. Then we often unlever this beta to remove the effect of debt. Find comparable companies, unlevered betas, average them, and then relever it based on our target company's capital structure. This provides us with a forward-looking fundamental beta rather than just a historical snapshot. Now, directly from the market data, you need to jump onto the beta computation. So for beta computation, what you need is basically the historical data, index prices. So in our case, it is going to be Nifty 50 for those number of dates that you have captured in column A. Then the Nifty 50 returns. So how the returns will be calculated? The first return is going to be, for example, days closing price minus the previous day closing price divided by the previous day closing price. So that's talk about a one-day return on Nifty 50. Target company that is in place, you take the historical data for that is the closing prices of Ashok Leyland for the number of dates that you have captured in column A, and calculate the returns in column E similar to how you have computed the returns for in column C. So here you have it. I got the data from investing.com and I have computed the column C and column E. Accordingly, you can see the formula B2 by B3 minus 1. Now, once you have done this, you can simply and calculate the levered beta. Now, the levered beta can be computed using the formula of slope. So you need to type equals to slope or the company. You need to type in the formula is equal to slope. The company that is your target company, the returns of that, comma, all of the returns of the index that you're comparing it against. If you press enter, this will give you the value of beta. I just created a sort of a chart over here between the returns of Ashok Leyland and the returns of Nifty 50, how exactly they look like in historical perspective. Once you have beta, we feed it back into our assumptions to calculate our weighted average cost of capital or WACC. Look here on the assumption sheet, we have explicitly laid out every component for our WACC calculation. We have our risk-free rate typically based on long-term government bonds, a market risk premium, the additional return investors expect for investing in the market versus a risk-free asset, the cost of debt reflective of the company's borrowing costs, and of course the corporate tax rate. Each of these parameters is a critical lever in our valuation engine, and by explicitly defining them here, we ensure clarity and control over valuation outcome. We come down to the valuation parameter. Risk-free rate that has been taken as the rate from a long-term government bond, market expected rate, which is the market risk premium that the equity shareholders would expect, calculation of beta that we have done in our beta sheet, the capital structure, which is debt over equity. So all your short-term debts divided by the market cap of the equity will derive the capital structure of the firm. The tax rate can be identified. The tax rate can be simply identified by the current year tax expenses divided by the PBT values. Cost of debt, which can be simply computed by taking the current year interest that is paid to the bank divided by the EBIT. Then we have the terminal growth rate, which is usually a rate that is a perpetual growth rate, and we assume that the company is going to grow at this consistent rate after a given set number of years. So in our case, since we are projecting the growth till 2029, beyond 2029, we are going to assume a rate which is really suitable as per our scenario selector and put it as the perpetual growth rate in the terminal growth rate value. Where is it used? All of these parameters are used in the DCF valuation, and we are going to cover all of this in the end part of the video. This brings us to a frequently asked question, a puzzle many modelers face. How do I decide what goes into my assumption sheet? My simple yet powerful take on this: whatever is an independent variable, take it into your assumptions. These are the drivers, the inputs that you control or explicitly forecast. However, whichever is a dependent variable should be computed in its respective sheets using the formulas. Let me illustrate. Revenue growth rate, that's an independent assumption. We are assuming a certain growth, but revenue itself, that's a dependent variable calculated by applying that growth rate to the previous year's revenue, like on your income statement. Similarly, our depreciation rate is an assumption, but the depreciation expense is a calculated outcome on the asset schedule and income statement. Think of it this way: the assumption sheet is your control panel. It's where you make strategic choices and define the parameters that will govern your model's output. Everything else flows automatically, ensuring consistency, accuracy, and ease of scenario analysis. This distinction is fundamental to building a clean, robust, and auditable financial model. Let's quickly walk through how we have assumed things item by item in our Ashok Leyland model on this sheet. We have grouped them logically for clarity. Revenue assumptions are core growth rates for the forecast period, transitioning into a terminal growth rate for a long-term valuation. Cost of goods sold, COGS, and operating expenses, OPEX, we have assumed that these are a percentage of revenue, a common and effective approach for forecasting operational efficiency. Working capital assumptions, short-term borrowings, lease liabilities, other liabilities, and advance from customers. Now, if you specifically see the trade payables, so trade payables are taken as a days of raw material cost. You can simply check the formula in the sheet that I have used. Now, going to the asset side of the balance sheet, the current work in progress, which is taken as a percentage growth, investment, again a percentage growth, loans and advances and other asset items, again as a percentage growth. Trade receivables and inventories are taken as days of raw material cost. Now, these two parts, along with the trade payables, can be captured in working capital schedule. For simplicity's sake, I have directly taken them in the assumptions. Here you will see specific assumptions like inventory days, receivable days, and payable days. These directly drive our working capital needs. Capex and depreciation are capital expenditure as a percentage of revenue and the average depreciation rate feeding into our asset schedule. All the PP&E, the future years, are projected using the asset schedule. Debt and financing assumptions, key inputs like interest rate on the debt. The borrowings, that will be the percentage growth as we have taken in the case of revenue, which would normally link to a full debt schedule but are assumed here for simplicity. Taxation, our effective tax rate, crucial for post-tax profitability. Valuation inputs, as discussed, are beta, risk-free rate, market risk premium, and other WACC components. Each of these assumptions is a carefully considered input based on historical performance, industry benchmarks, and our future outlook for Ashok Leyland. This sheet is truly the central nervous system of our model. Now, let's talk about one of the most powerful features in any robust financial model, scenario analysis. Look here, our scenario selector, optimistic, moderate, and pessimistic. Why is this crucial? Because the future is uncertain. Our single point forecast is rarely sufficient. By building in a scenario selector, we can instantly pivot our entire model to reflect different economic conditions, market responses, or operational inefficiencies. In our model, changing this dropdown will automatically adjust our key assumptions, perhaps higher revenue growth in an optimistic scenario or tighter margins in pessimistic one. This allows us to stress test our valuation, understand the range of potential outcomes, and ultimately make more informed, risk-aware decisions. It's about building flexibility and foresight into your analysis. Finally, a common question I get: why isn't cash and cash equivalents part of the assumptions? The answer is simple. Cash is the plug. It's the residual item that balances your balance sheet. It's the output of your operational, investing, and financing activities, not an input. If you were to assume a cash balance, you would likely break the fundamental accounting equation, that is, assets is equal to liabilities plus equity, or disrupt your cash flow statement. Your cash balance is dynamically calculated, usually on your cash flow statement, and then flows directly to your balance sheet. It's a dependent variable, the ultimate result of all of your other assumptions and calculations. Balance sheet drivers. So for example, the equity capital I've kept as flat at 294 because historical values were flat at 294 crores. The reserves will include the bank reserves and the retained earnings. How do you compute the retained earnings? Basically take it from PAT, from income statement. So for the future years, we are not going to assume these numbers, rather we are going to take them from the income statement read. Then we move on to the cash flow statement drivers. This will talk about the bifurcation of the cash flow from operational activities, cash flow from investment activities, and cash flow from financing activities. So for the future years, for the simplicity's sake, you are going to assume the rates by taking an average. So here you go. I have populated all the values, that is the drivers, in the assumptions sheet accordingly as we discussed during this walkthrough. My simple take, always put that in the assumption sheet, which is an independent driver, and whichever is a dependent driver, use them with the actual formulas. And there you have it. In this first video, we have laid the critical groundwork, understanding market data, building essential supporting schedules, crafting robust assumptions, demystifying valuation inputs like beta, understanding and independent versus dependent variable philosophy, and unlocking the power of scenario analysis. We have set this stage for an incredibly powerful financial model, but this is just the beginning. In our next video, we are going to take these foundations and build our core financial statements, the income statement, balance sheet, and cash flow statement. You won't want to miss it. If you found this valuable, smash that like button, subscribe for more masterclass content, and hit the notification bell so you don't miss the part 2. Leave your question in the comments below and let us keep the conversation rolling. Until next time, happy modeling.